Now, Don has an issue with a stock, and he looked at a stock repair using the stock repair tool on Power Options. And Don wanted to know how he can see how the position will change over time using the tools on Power Options. What is the stock repair tool? Well, the stock repair tool is a nifty tool. When you have a stock that's down in price, you can put your numbers into the tool and potentially see a repair using a ratio call spread. But before we do that, anytime a customer brings to me a stock that says they want to do a stock repair or look at ways that they might manage it, I want to get a bird's eye view. So we'll type in Don stock, INMD, into the symbol field, and we're going to go to quotes first. And this gives us all of the information that we have for the stock itself. In mode, INMD, we see we're here at $28.50, so Don's down about $11.50 per share on the position. But one thing I wanted to note here, of course, is the next earnings coming up and if there is a dividend. Not that the dividend would really affect the stock repair at all. We just want to have that knowledge of what's coming up on the position before we make any decision to enter into a stock repair management technique, selling a covered call against the position to try to repair it. We don't want to necessarily cap our gains too much. However, we're probably not expecting the stock to move back above 40 with the earnings coming out in just a few days on July 28th. Next, let's take a look at the chart real quick, just see where we stand. So we'll go ahead and go to big charts. And we see the stock bottomed out near $21 per share, almost $22. And it recently has had a good move up, positive MACD crossover about a month ago, and it broke above the upper Bollinger Band about a week ago. So it's showing a promising trend, but it did take a hit today, as we saw, down from where it was about 30 back down to the 28.50. So we are seeing some strength in the stock after those lows, bottoming out around 21 or so. And that's good to know as well. Let's go back to Power Options, of course. And same thing, we'll just type our symbol into the lookup field, and we'll click on Stock Repair. This is one of our signature tools that's available. And all we have to do is put in our cost per share. So we have $40. And Don has 200 shares of INMD at that price. Let's go ahead and click Submit. Now, we're not seeing a lot here. What the tool tried to do is look at all expiration dates available. And it tried to build ratio call spreads by buying one contract and selling twice as many higher. Well, the contract size, I should say, is based on the number of shares. So it was trying to build repairs of buying 2 lower strike calls and selling 4 higher strike calls. We see some repairs that do give a net credit on the position. However, it does not get the position back to break even, so we don't see any trade details available. I prefer to do a credit repair if possible when using the stock repair. But in this case, none are available. The only one that is available is a debit repair out to January 2023. The system found a debit repair where we could buy 2 27.5 calls and sell 4 35 calls. Now, although this is building a ratio call spread at hopefully a credit, but in this case, we're going to see a debit of negative 50 cents on the position. Nothing is naked. Essentially, we're entering a covered call where 2 of the 35 calls that are sold will be covered by our 200 shares of stock, and the other 2 35 calls that are sold will be protected by the 2 27.5 calls that we're buying. So essentially, we have a bull call debit spread with a covered call position. Let's take a look at the repair details available for this debit repair on INMD. So this is the stock repair that was built for the position with our values of INMD at 40, 200 shares for Don. We only have a debit repair. Clicking on repair details, this gives us the breakdown of the structure. Now, again, 2 contracts at 620, we're paying out 1240, we're getting 1140 back, so we have that extra debit of 50 cents. I prefer to only do the stock repairs if it's a credit, but the debit could be good as well. Now, essentially what we're doing is we're entering one bull call debit spread with 2 calls at 27.50 and 2 calls sold at 35. and a covered call position with our stock that we bought at 40 and 2 calls sold at 35. So nothing is naked. Even though this is a ratio call spread, nothing is naked. Everything is covered. Now, what happens when the stock reaches $34 on January expiration? We're still down $6 from our $40 purchase price. We paid a debit of 50 cents into the position. But if the stock's at 34, our $27.50 has $6.50 of intrinsic value, and the 35 calls still expire worthless. We sell to close those 2 calls at $6.50 and sell to close the stock at 34. That takes care of the loss on the stock, the extra 50-cent debit, and we're back to break even, $6 less than our purchase price of $40 per share. But this is based on holding it all the way to expiration. Don's question was, how can I see what the options would be worth between now and any time between expiration if the stock is fluctuating in price? Well, if you do find a repair that's available, click on Repair Details, go to Analyze Trade. This just takes you to the profit and loss chart with your numbers entered in. Our 200 shares of stock at $40 per share. Buying 2 January 27.50 calls for $6.20 and selling 4 January 35 calls at $2.85. This gives us our stock repair position where we can see now break even is 34. And if the stock's at 35, what happens? We get assigned on the covered call. We get the maximum profit back from the bull call debit spread. We actually have a 5% return. The stock's trading at $36 per share, still $4 below or 10% below our purchase price. Not a bad repair, but it is out to January. It is 6 months away, and this max return is based solely at expiration when all time value is decayed out of the position. Curved red line on this profit and loss chart shows us the gain or loss expected at the halfway point on October 24th, when it's still going to cost a lot to buy to close those 35 straight calls, and there's still going to be some time value left on those other 2 calls that we bought, but that's not going to get us back to break even. It's based on holding it to expiration. But what if INMD exceeded expectations and come around October 24th, the halfway point, it was actually back above 40 and had gone to $42 per share? Well, unfortunately, because of the time value still left for those 4 months remaining, or 3 months, remaining to January expiration, it's still going to be at a loss of $3.64. Now, I could manage half of these calls. I'd leave the bull call debit spread open, but I could have rolled these 35 calls, 2 of these 35 calls up as the stock hit that price, continue to manage that portion just as a covered call, but still allow that bull call debit spread to get closer and closer to maximum profit. But this is the tool that you're going to use if you're valuing any position to see what it would be worth if the stock moved up in price anytime between now and expiration, so you can see the value of each of the legs, the expected value. And if you expected change in volatility up or down, you could change that as well to aid in the calculations of the monetary gain or loss of this position. So Don, that's how you analyze it, whether you're looking at a stock repair or whether you're just looking at a profit and loss chart, maybe one of those bull call debit spreads that's 90 to 100 days out in time we just looked at a moment ago. That's what we would kind of look for. You go to that, I'm sorry, let me go back here, back window, right? Yeah. After you look at the repair details to see the description of the repair, click on Analyze Trade there to get you to the profit and loss chart. And once you get to the profit and loss chart, you can run those scenarios using the Calculate feature underneath of the main tool. Now, one thing that we should point out as well is that although this position can help us get back to break even at a much lower price if everything works out, it is out to January. And we saw that we are going to cross an earnings date in the next few days on July 28th. Also be crossing another earnings date on or around October 28th as well. Now, although that could benefit if the stock really gapped up high in price to get us closer to the full repair, as we saw using the Calculate feature, even if the stock was at $38 or $39 per share, we didn't get the full effect yet of the stock repair because there would still be time value remaining on the 35 calls and, of course, on the 27.5 calls that would work to our benefit. But to exit the repair, we'd have to buy to close the 435 calls and sell to close the 227.5 calls. But with that time value still remaining on the position, it doesn't look like it gets us to where we want to be just yet. But that is something to keep in mind. The other important factor to keep in mind is the stock repair helps get you back to break even faster if the stock moves up as you're expecting. In the case of a debit repair and even the credit repair, it isn't doing anything to address the downside. If INMD falls another 2, 3, or 4 points at the earnings coming up on July 28th, we didn't protect the further loss we could take on the stock position itself. So, can you just add a put to it? Well, not necessarily, because that will change the dynamic of the entire position. Let's say I wanted to protect INMD in case of a bad earnings, or at least hedge some of it going into the earnings on July 28th. Maybe Don decided to do this stock repair, but he's also worried about the earnings. We'll go out to August, the cheapest price, and let's just go ahead and use the 2250 strike. The 25 is pretty. Let's go do the 25, just an additional 90 cents on the position. And since we have 200 shares, we'd have to buy 2 puts to cover that. How is this going to change the dynamic even though it's shorter term? Well, it kind of gets strange because this is looking at the break even now at the nearest term expiration. Yes, we've hedged the maximum potential loss to 39.6%. That's factoring in the $11.50 we're already down from the 40 points and can still lose another $3.50 because this insurance policy wouldn't kick in until the stock falls below 25. Now, it says that we could still make a profit if the stock's really high. This is because it's looking at August expiration, not January 2023. It's looking at the nearest term. So sometimes in these situations, an extra put might help if you're heading into earnings and you're trying to use the stock repair as well. But you just have to keep in mind how it's going to change the dynamic of the repair itself and evaluate if going 180 days out for the repair is going to match your goals for getting back to break even on the position. Maybe you could just sell shorter term calls out of the money, let's say it's a 30 strike. But that would take a long time, probably longer than 180 days with only monthly expirations available to reach the $11 we're currently down on the position. When you're evaluating a stock repair or you're staying in a position to try to repair it, you have to look at the stock new, sort of reevaluate where it stands, because the repair itself or just selling out of the money covered calls to try to get back to break even is going to rely on the stock price moving up as well. You're still going to have a bullish outlook. If your sentiment has changed, you're no longer bullish on the position, although the stock repair by itself, let's clear out our put option there, can be very powerful to get us back to break even at a much lower price than our purchase price if a repair is available. We still have to ask ourselves, what is our sentiment on the stock going forward? Is it worth it to stay into this position and tie up the capital longer to try to get back to break even? The answer is probably yes. It's better than taking a loss right now or realizing the loss, just selling the position and looking for something new. But again, if your sentiment is that the stock isn't going to recover, you want to ask yourself, how long do you want to tie up the money for and stay in this position if it's not matching your sentiment for a long stock position? That today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as recommendations or direct trading suggestions. Options involve risk and may not be suitable for all investors. Now, we had a chance to go through a lot of the tools today. We looked at the stock repair tool. We looked at the search tool earlier, although we didn't adjust any of the criteria there. We looked at the profit and loss portfolios a little bit. We didn't look at a rollout opportunity and position analysis, which you can do for many strategies. And of course, we looked at the custom spread tool. But for 14 days, you can get full access to the full suite of tools and power options. No credit card required. Just go to powerop.com, put in your name and email address, and start your 14-day free trial. You get use of the search for all 23 strategies, the default searches, the signature tools. You'll have 3 months limited back testing capability in those on the trial as well, and full access to the portfolio tools as well. After that, subscription start at only $45 per month. That's for the end of day data. The most popular subscription service seems to be the 20-minute delayed service at $65 per month. So the data, when you run a search, you're looking at your portfolio, it might be 12 to 15 minutes delayed. The upgrade from the delayed is the historical service. It gives you everything on the delayed service, but for only $35 more, you get the full 7-year or 7.5-year access to the historical data for back testing in the 23 different strategies and historical options chains. We do, of course, offer the real-time service, and the premium service includes everything. The real-time, 7 years of historical data plus access to the API, the programmer's interface. You can cancel at any time. There's no contractual obligations. Free coaching is available on all levels of subscription. A coaching session is essentially a 35 to 45-minute phone conversation with myself and Ernie. You can upgrade at any time, and you have, of course, full access to the webinar archive. Speaking of which, at any time, you can go to Power Options, click on the webinars there, and go through the different sections of the Power Options tools, options strategies, options concepts, requested topics, or just head on over to YouTube. Most of our videos are published there as well to the public. You can check out the videos there. You can do a search for a name, bull call debit spread, at the money debit spread, in the money credit spread, however you want to do it. A poor man's covered call. You'll see the variety of different things there. Check out the playlist as well also. Now, if you do think of any other questions, remember, send me an email at any time to support@powerup.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And as I mentioned, trial members and subscribers, you can schedule a free coaching session at any time.